Tech earnings are always very expected, and this week we also saw the FAANg reporting earnings. I know it is FAANg as Facebook, Apple, Amazon, Netflix, and Google, but we saw Netflix reporting earnings last week and Microsoft earlier this week. Hello everyone, welcome back to the channel. Today we will analyze Facebook, Apple, Amazon, and Google earnings report, and after that we will compare all of the FAANg plus M, which is Microsoft, to see which one has a better valuation right now and which one I am investing on right now. Also, I opened a second channel in Spanish where I post almost the same content as in this one, but in Spanish, so it would mean the world to me if you go and subscribe and share the channel with any friends and family. First of all, the almighty Facebook, ticker symbol FB. It is currently trading at $321.51 per share and has a market cap of $936.22 billion, a forward PE of 22.46, and a price to sales ratio of 9.92. They have a total daily active user of 1.87 billion, which is 8% more than last year. They have a total of 2.8 billion monthly active users, which grew 9.6%. And lastly, they added over 460 million monthly active people, which is a 15.4% growth year over year. We can see that on their average revenue per user, geographically speaking, Europe saw the highest growth and Asia Pacific the lowest, but Asia Pacific are the biggest amount of users in monthly active users and daily active users. Facebook reported a revenue of $26.1 billion, beating analyst expectations, which was an excellent growth of 47.5%, all the way up from $17.7 billion. Something I have always looked at with these tech giants is to see that their expenses are decreasing, and as you can see, their expenses as percentage revenue is in a constant decrease, and even though they have been growing massively, their cost of revenue has kind of stayed stable at 19 to 20%, which is impressive. Then their income from operations actually grew by a lot. They reported $11.37 billion, which is a 93% growth year over year. Same with their net income. They reported a total of $9.5 billion, which is a growth of 93%, but it is a margin of 36.2%, which is very nice for such a growth company. Now, on their balance sheet, they reported a total of $19.5 billion in cash and cash equivalents, which is a sum of $64.2 billion, which slightly increased year over year. They reported a total asset of $163,523 million, but as always, take into consideration that they have a total of $19 billion between goodwill and intangible assets, which I don't like to take into consideration. And then total liabilities of $29.8 billion, which decreased nicely. We do have to take into consideration that Facebook attributed a significant increase in revenue to a 30% year-over-year increase in the average price per ad and a 12% increase in the number of ads delivered. Now, remember last year when the boycott happened and many people said that it was crazy to invest in Facebook because after that they had several issues during the elections and many other issues, and the pandemic happened, but the truth is that as long-term investors, short-term inconvenience should not matter unless they change the fundamentals of the company. During that period of time, I always said that that was going to pass, and that even though it was tough to see Facebook stock dropping for weeks, it was actually creating a nice opportunity to buy. See where we are at right now, way above the $300 mark. Now, we do have to take into consideration that because of the new iOS software update, the company is bracing for ad targeting headwinds because of Apple's recent privacy changes on iOS 14 that may make it more difficult for the company to personalize ads for iPhone and iPad users. This is something I want to see how people react and how it affects Facebook, but remember that Facebook is also expanding into the e-commerce business or e-commerce world with Facebook Shop and many more, so I'm not that worried right now, but I do want to see how that affects them. Second company, Apple, ticker symbol AAPL. It is currently trading at $132.98 per share and has a market cap of a whopping $2.23 trillion, a forward PE of 25.67, and a price to sales ratio of 6.86. They reported earnings this week, and as they said, they are proud of their March quarter performance, which included revenue record in each of our geographic segments and strong double-digit growth in each of our product categories. These results allowed us to generate operating cash flow of $24 billion and return nearly $23 billion to shareholders during the quarter. Apple reported a total of $89.5 billion, which was a whopping growth of 53.6% year over year. $72.6 billion came from their products and $16.9 billion were from their services. But see how even though their services is their smaller segment, it is still growing massively year over year, 26%. That is insane. Then they reported a nice gross margin of 42% and a net income of 26.3%, which was $23.6 billion. Then on their balance sheet, they ended with $69.8 billion of cash on hand, which decreased from $94 billion, but still their total assets increased from $323 billion to $337 billion. Now their total liabilities increased to $267.9 billion and saw an increase in long-term debt as well. Now, on their cash flow statement, we can see that they spent some money on marketable securities. Well, not some, $74 billion and $5.7 billion acquiring property. Then, on their financing segment, we can see that they spent $43.3 billion repurchasing stocks, which is actually excellent for us investors. $4 billion paying debt and $7.06 billion paying dividends to us investors. Then, even though they saw an excellent growth in all their products and services, their fastest growing was the iPad, which grew a whopping 78.7%. Then the Macs, the iPhone, the services, and lastly, wearables, home, and accessories. To be honest, it is impressive to see such a growth for the iPad, but I would assume it was because of their iPad Air release, which I bought one and have to say that it is excellent. I used to have the Pro when I was in college, and now I have the Air, and have to say that for the price I paid in comparison to the Pro, it is an excellent performing iPad. And this month they released some nice products such as the iMac with the M1 chip, the new iPad Pro with the M1 chip inside as well, which is a huge improvement for the iPad. Then an Apple TV 4K and the most anticipated product, AirTags. But I'm not a tech reviewer, so let's continue reviewing the company. Now, geographically speaking, the company has grown nicely. Even though 38% of their sales come from the Americas, Greater China grew 87% year over year. The next stock is Amazon, ticker symbol AMZN. It is currently trading at $3,513 per share with a market cap of $1.77 trillion. A 4P of 52.85 and a price to sales ratio of 4.59. Amazon reported an operating cash flow increase of 69%, free cash flow increase to $26.4 billion. They diluted a little bit their shares, and net sales increased a whopping 44%. As of right now, Apple is winning with the revenue growth, but let's see how Google did later on the video. Then Amazon reported operating income of $8.9 billion, all the way up from $4 billion, and net income of $8.1 billion, which is a 7% margin. Just like Apple, both revenue segments are growing a lot. Their net products grew 37.4% and their net services a whopping 51.8%. On their balance sheet, their cash on hand decreased from $84 billion to $73.2 billion. Reported a total asset of $323 billion and total liabilities of $219.7 billion. Now, see how their net sales have increased nicely year over year and quarter over quarter. 61% of their sales come from North America, 28% international, and 11% from their AWS, which is their Amazon Web Service or cloud business. I do think that even though their growth has been excellent for several years, they will continue with that kind of growth because retail sales are only 15% in the US online, while in China it is all over 52%, which means that Amazon still has way more room to expand in the US. Now, Amazon was one of my picks for the video talking about undervalued stocks and was one of my monthly picks in April or March. I can't remember perfectly. Obviously, it was a way better buy when it dropped below $3,000 in March, and still thought it was nice to buy at $3,300 last week. But even though the stock has gone up about 18% in a month, I think in the long term, Amazon will also be a nice investment, but will it be the best investment between the FAANg stocks? We will see that later on the video. Lastly, Alphabet, ticker symbol GOOG. Currently trading at $2,357 per share with a market cap of $1.59 trillion, a forward PE of 25.50 and a price to sales ratio of 8.09. Google saw a nice revenue growth of 34% year over year as they reported $55.3 billion, a nice operating income of 30%, and net income of $17.93 billion, which is a margin of 32.4%. Then, as we can see here, their fastest growing segment last quarter was YouTube ads with a growth of 48.7%. Then Google Cloud 45.7%, which might increase even more next quarter as they will start charging for Google Photos in June. As a side note here, if you want to upload your photos to Google Photos, this is the moment to do so as that will keep being free, but everything uploaded after June will start counting as the 15 gigabytes that you have for free, and then you will have to start paying. As a side note here, so you know, they have total cash of $135 billion, which slightly decreased year over year. Have total assets of $327 billion, which again, I would not take into consideration the goodwill and intangible assets. And total liabilities were almost flat at $97 per share. Now, let's compare all these companies plus Microsoft and Netflix. But before that, I do have to say that all these companies have continuously had excellent growth year over year, are the biggest tech companies, and continue growing massively. And I do expect that to continue as they continue innovating tech. Now, let's compare the companies to see which one would be the best investment right now. Okay, so in this graph, in this chart that I created here, we are comparing Facebook, Apple, Amazon, Netflix, Google, and Microsoft. At the end of this analysis, we will see which one is the best company to invest in right now. As you can see, here is a stock price of every single of the companies, then the stock change. Here is where we start analyzing the company. The stock that has gone up the most in the last 5 years has been Apple and Netflix. Both have gone up 468%. Which is very, very nice. Then we have Amazon, then we have Microsoft, then we have Google, and lastly, Facebook. Under market cap, we already know that Apple is the biggest company right now with $2.2 trillion. Then we have Microsoft, Amazon, Google, Facebook, and lastly, Netflix. Okay, we already saw that Apple won here and Netflix won here. For the market cap, we don't have a winner because we know that Apple is the biggest one, but that doesn't mean anything right now if it's a best investment than the other one. What impressed me the most comes after. So the 4P, you know that the best one. So in here, Facebook would win because they have a 4P of 22.46. And we know that Amazon tends to have a high PE ratio of 52.85. I mean, it's not good to see that kind of 4P, but we know that these kind of growth companies like Amazon and any other like Netflix or Microsoft tend to have a high PE ratio because of their growth. So in this one, we would make Facebook as the winner. Then for the price to sales ratio, the smallest, the best one. So for this one, we can see that Amazon is actually winning. Even though they have the highest PE ratio, the 4 PE ratio, they have the lowest price to sales ratio. So in here, we see that Amazon won. After that, we can see that Apple, then Google, then Netflix, Facebook, and lastly, Microsoft. This does not mean that the other companies are bad. I'm just saying that Microsoft is the best one in the price to sales ratio section. Then for the revenue, we already saw all of their revenue before, and I already have a video analyzing Netflix and Microsoft on my channel if you would like to see them after this video. But the revenue growth is impressive. The winner here, surprisingly, is the biggest company, 53.60% revenue growth for Apple, which is a $2.2 trillion company. 53.60% for a huge company like Apple. That's why Goldman Sachs said that they were wrong with Apple, because they were not expecting, or I think no one was expecting, or no analysts were expecting to see Apple growing 53% in a single quarter. Now, after that, we see that Facebook is the second one, then Amazon, Google, Netflix, and lastly, Microsoft. Then, for their net income margin, the winner here is Facebook. They have a margin of 36.20%. That's huge. Then Apple 26%, then Google 32%, 23% for Netflix, 7% for Amazon, and 37% for Microsoft. I do get that 7% for Amazon is smaller, way smaller than the rest, but we have to take into consideration that companies invest a lot of money, or have to invest a lot of money in order to continue innovating and creating and growing as a company. So it's not the best margin, but still it is very good for a high growth company like Amazon with a 44% growth year over year. So I can't complain. Then on their balance sheet, we saw that all of them have a lot of money on cash. So if we add all this up, we will see that all of them together have $476 billion in cash. 476. They could buy a lot of companies with that amount of money. Even just Google with $135 billion could buy a lot of companies and add it to their portfolio, or just invest in their companies to continue growing and growing massively as they've been doing for years. Then the current assets, we already saw all that. Total assets for the companies, current liabilities, and total liabilities. So I put these numbers here because I want to talk about the current ratio and total liability to total assets ratio. This tells us how much money they have, or what is the liquidity of the company, or how much money they have to pay the debts in case of a crisis or something like that, for example. Then the current ratio, we know that the highest the better, because that means that they have way more short-term assets to pay their short-term debt. So for this one, the winner again is Facebook, since they have 6.08 as a current ratio. Then we have 3.10 for Google, 2.29 for Microsoft, and then the rest are about 1. I'm not saying that these are bad. All of these are very good companies, have excellent balance sheets, because everything above 1 is way better. Just that the best one is Facebook. Lastly, total liability to total assets ratio is how much of their assets they have in liabilities. So for this one, the lowest, the better. So the winner here will be Facebook with at 18.26%. Now, obviously, Apple is kind of high, Amazon is kind of high, and Netflix is kind of high. Microsoft, it's fine, it's 56%. Everything below 50 or around 50% is nice. I'm not saying that this is bad for this company, because you have to take into consideration that yes, they have 79% of their assets in liabilities, but they're also growing 53% year over year. That is huge for a company of $2 trillion. Now, obviously, after seeing this, we know that the best investment is Facebook, because they have 4 points. But we have to take into consideration that Amazon has the smaller price to sales ratio as well, or Facebook has grown the most, and stock-wise and revenue-wise, and that Netflix has also grown, and Microsoft and Google growth has also been very nice. What I want to say with this is that all of these 6 companies are excellent investments, in my opinion, for the long term. I do think that they will continue innovating, investing money, and growing massively year over year. Obviously, we will see some slowdown and then very high growth like this ones, because this was extremely high growth for this kind of companies. And I know that I think that in the long term, they will continue growing and continue innovating as a company, and they will be able to continue giving us investors a nice return like they have been having, because at the end of the day, the smallest one was Facebook with 177%, and that's actually very good return in 5 years. I know that's not almost 500%, but still it's a very nice return. Right now, I'm investing in Facebook, Apple, Amazon, and Microsoft. I don't own any share in Netflix or Google. Nothing wrong with them, just that I started investing in Apple because I'm an Apple addict. I have everything that Apple good Apple releases. Then Amazon, because I love e-commerce. The e-commerce industry is a high growth industry. Microsoft is an excellent growth company as well. And Facebook, it's tied to e-commerce, and I was using them when I was doing drop shipping, so I invested in them. Then for Netflix and Google, I use both of their platform even more than the other ones because I see a lot of Netflix, I watch a lot of Netflix TV shows and movies, and I use Google every single day. Hope you enjoyed the video. Please smash that like button and subscribe since it really helps the channel out. It took me a lot of time to do this research for this video. Hope you enjoy it. Thank you and see you next time.